Ladies and gentlemen, welcome to the Capital Flows live stream. The entire goal of these live streams every single day at 8:30 a.m. Mountain Standard Time is to break down the entire macro regime and be able to understand all of the changes in price action, and then specifically build a foundation of knowledge that is not a one-off moment, but allows you to be better and improve every single day so that every single live stream that you're a part of, you actually get better and you have a better framework for how to think about all of the big picture things and all the small details in markets. And so myself and James are going to be here every single weekday, breaking everything down. So I'd encourage everyone to continue showing up. If you are here, put a comment in the comment section and let me know what markets you are focusing on or the questions that you have, anything that you have really been digging into in terms of the research reports I'm putting out on the Substack and all of the changes that we are seeing in markets right now. And then if you're on Twitter, I'd really appreciate it if you're able to reshare everything. And we will be walking through in today's live stream. One, we're going to kind of wrap up the week a little bit. And two, I titled this live stream, interest rates are the rise and fall, how interest rates cause the rise and fall of nations. And I wanted to talk about that because it is such a critical moment in time we are with all of these changes in geopolitics, changes with energy prices, changes with new Fed chairs. And it's so critical to realize the significance of it so that you don't just kind of shrug it off as another news headline part of the cycle that is irrelevant. So that's what we'll be talking about today. James, thanks for joining. How are things on your end? Any thoughts on what we're looking at for price action and the changes we're seeing in markets overnight?
I think this is just another great continuation example of what we've run through this week. I think if everybody has been, if you've been showing up to these live streams, you could hear me, right? By the way.
Yep. Yeah, we're both coming in. Yep.
If you've been showing up to these live streams, pretty much what's happened this week, you should almost have a pretty solid understanding of, even though it's very choppy and whipsaw. Like, just to pat flows on the back here, I feel like we're seeing a lot of the results of what we've talked through, right? Some of the, if you recall back to Tuesday or Wednesday or whatever it was, we had some people saying, oh my goodness, what's happening to Oracle, right? And things like that. Well, if you look at Oracle today and you kind of look back over the whole week, we are right where, we need to be. Was there noise? Sure. But again, it just goes back to like understanding why you're here, understanding the thesis behind why the asymmetric bets that we're making are happening. And here we are kind of bouncing off some of the things we discussed yesterday and in the stream before. And again, this is why I think it's important to show up every day, understand what exactly is going on, and just imagine doing that for a few months in a row, and how much better of a trader you'll be.
Yeah, I think the thing I like to think about is how am I having intentional iteration in everything that I'm doing, right? I think that you can always show up every day, but you can show up at the gym every day, but if you're not actually working out, you're not getting anywhere, right? There's always those people that show up at the gym and you're just like, what are you doing here, man?
Hey, they're showing up, man. That's all that matters. That's
okay.
A big part.
We're all starting somewhere, okay? I think that the entire goal, and what I would challenge everyone in this section to do, if you're in the stream or the comment section of Twitter, I'm also watching the comment section on Twitter. So if you have any questions, put them in the comment section of Twitter. And then if you are watching this live stream while it's being recorded, you can also put questions there as well. And I'll come back either later today or tomorrow, and I'll go through those. So if you're watching this later, you're still having, all of the entire goal of everything that we do is so that it's not some clickbait moment in time focused on the news cycle, but you actually have this base of knowledge that you can say, now I know things so much better to head into next week, to head into how to think about this weekend. And so again, put questions in the comment section. If you're watching this on Twitter, do me a favor and just retweet it so that everyone's aware of everything that we're doing. If you are not on the Capital Flows Research website yet, go to capitalflowsresearch.com. Every single slide deck and chart that I cover in today's section will be laid out there. And then again, my entire goal in markets, this is just how I trade. Map the macro regime so I'm on the right side of it, and find a few large asymmetric bets that become home run trades. My largest bet right now, and I've been laying this out for a very long time, and I actually want to start with this before we get into interest rates, is the PER hyperliquid treasury company. You will notice that in the last session, last night, you had a ton of volume go through the price yesterday, basically at the close. Someone bought a ton of shares, and it's not surprising that we're up right now. But you had someone buy a ton of shares, and you can just see the volume. I mean, this was one of the second largest volume day in PER since its merger. So you can see right here, we had 3.23.
Can't see the screen if you're sharing something else.
In PER right here, we had the largest kind of day in volume, 3.2 million shares, just below this other move right here that we had, which was 3.25. I mean, just over it, just a little bit, 3.34. And we're setting up for a very interesting period of time for hyperliquid. I mean, I have to go over this before we, because this is just so critical for this entire period of time with IPOs. This is one of the charts that I shared, and Trade XYZ are introducing pre-IPO perpetuals so that if you want to understand, or if you want to bet on the changes in IPOs right here. So this week, before an IPO are some of the most consequential in a company's price history, and historically the least observable. Private market quotes are stale and gated, and public markets haven't started trading yet. Peak interest coincides with an absence of prices. We are introducing IPOP markets in XYZ to change that. So Trade XYZ is the major builder of perps on the Hyperliquid protocol, and they are now launching pre-IPO perpetuals. And so just think about it. All of the, hopefully, SpaceX pre-IPO is going to be traded on Hyperliquid. And this is going to be one of the most, significant things, because if you have that take place, then you are going to have so much volume go through the Hyperliquid protocol, people don't even understand. And on top of that, we are moving into a time where IPOs are popping off. And so if you recognize that you have this inflection point, I mean, here's a chart that I shared of IPOs through 2020 and 2021. I mean, we had some of the largest IPO volume and values in history in 2020 and 2021 right here. We've now moved into a period of time where those are beginning to accelerate again, but we're not at the same levels. So just think about how Hyperliquid is going to become the focal point for IPO speculation that didn't even exist in 2020 and 2021. And so this is going to, you had Hyperliquid rally when equities sold off earlier this year because everyone was running through volume on crude. Now what we're going to have, in my view, I mean, this is still yet to be seen, but all of the evidence is pointing in this direction, is that once you have all of the IPO volume and all these other equity volume run through during a melt up, then Hyperliquid becomes one of the biggest beneficiaries because of its disruptive nature in perps in the entire financial system. And so this doesn't even count for, all of this stuff is happening, and it's without, it's at the, if it doesn't get added to the United States, I think it will this year. But right now, all of these innovative things are happening, and it's not even added to the United States. What do you think happens when it gets added to the United States and, large institutions begin to come in and arb these IPO prices and these different markets? it is going to be, I believe, one of the largest rallies in US financial history for Hyperliquid. And in the interim, before that happens, Per is the only way to functionally get exposure if you're a large player, because they're the largest Hyperliquid treasury company. And so, this continues to be my biggest bet. Something that, what James and I are going to actually discuss right here is that, someone recently said to me, well, you bought it down. I laid out, if you go back on the Substack, I laid out the entire thesis when we were, basically sub 350 in this range right here. And, basically below $4. And, we've rallied, but, basically from those levels, we've rallied almost 100%, right? Especially, when we're at these levels, 100% to highs, basically. And, I had someone recently say, well, now we're not at the lows, so I shouldn't buy right here. I'm not going to tell anyone to buy or sell anything because that's not what I do. I would just say, for me, I'm never thinking about, well, we're not down here, so I missed the opportunity. All I would think about is, well, can Per go to $15? If I think it's at 6 right now and it can go to 15, right? Up here at these levels, then I'm not thinking about, well, I didn't buy it here. I mean, that's just like, oh, well, I didn't start at the same time as everyone else, so I can't win the race. I mean, don't have that loser's mindset, that limited mindset. I'm not saying that you don't want to take into account these different changes, but a lot of people are, they don't want to buy unless they have unless they're buying at the beginning or the lows or something like that. And again, I'm not trying to push anyone to not be who they are in their trading style, but you want to think about, am I analyzing this based off of the risk reward, or am I analyzing it based off of just my own, insecurity because I didn't have perfect conditions to get my trade in? So James, you have a lot more experience in kind of thinking through some of those distinctions. Why don't you explain how you would think about someone in that situation a little bit?
Sorry, I wanted to bring up a couple of relevant things for people to Hyperliquid in the chat while you were discussing those. So I need you to repeat the question, but there's a couple places, just because there was a question early on, and I'll get back to what you were saying,
Yep,
but like,
go for it.
There's a question early on that was basically saying like, hey, you're mentioning this target price for Per, and like, what does the hype earnings need to be to compel institutions to buy and all that? Well, like, what you need to do here is go back to the original thesis as to what, it's not like, sure, it's a company and sure it has earnings, and that's all important. But like, you have to understand why this bet is being taken place in the first place, about the disruptive technology that it is, and that it's essentially a Trojan horse to bring in real world markets on chain. And I don't know if you want to tap on that, but like, you guys should save this website that I just linked in the comments, Hyperscreener, and you can start to work through and understand what exactly is happening on Hyperliquid when it comes to perp trading, HIP3, HIP4. I hadn't even seen that tweet this morning about the pre-IPO markets, but that's just another thing. We're hitting all of these different points, which is the housing of all of finance theory from Jeff Yan, right? So I just want people to really kind of maybe reframe exactly the bigger idea here of what Per and what Hyperliquid is. So I don't know if you want to touch base on that before you.
That's good. Yeah, so I think that's helpful. Let's zoom out and say, what in the world is Hyperliquid? Why do we care? Yeah. What in the entire world is Hyperliquid doing, and why should we care about them? And, one, I've laid out this thesis many times. If you go to the website, and again, if you're following the research, you already know all of this. Go to February 11th. I laid out the entire thesis for Per and Hyperliquid. And I actually laid out the entire thesis last year, December 9th, when I talked about the big bet that I was taking. And if you were a paid subscriber, you basically got all of this in real time. Now we're on sides and we have, a lot more, exposure. And the next big bet that I end up taking, I'll share with paid subscribers exclusively. But you can now go see it retrospectively and see the thesis I laid out. That thesis still remains. And that thesis is simply this, that the entire global financial system has been structured around futures as the primary way to get access to leverage. Hyperliquid is the place that is providing a new type of derivative contract called perpetuals. Perpetuals basically help you have all of the benefits of futures without any of the downsides. And on top of that, you're able to execute in a way where you don't have the same type of limitations for margin that you might have in the CME or Eurex or something like that. Whatever brokerage account you're using. I mean, those are the exchanges, but in your brokerage account, when they require margin, the margin is actually marked by the market. And then on top of that, you have it as the most liquid place to trade 24/7. And it just happens to be on crypto rails. That's why I don't really view Hyperliquid as a crypto token. Everyone's like, oh, well, alts are rallying because no, I don't even acknowledge that. Hyperliquid is a technology that has generated more revenue per employee than almost any other company in the world. They are a protocol that has more comparable metrics that are comparable to Mag7 than any other crypto coin in the world. I mean, it could hit, a comparable market cap just given the setup you have and the situation you have building. And so what I would say is that Hyperliquid is the place to get exposure to that disruption in the financial industry. And the entire edge right now is that it's currently unavailable in the United States. And so we're in the process of having it, people are already applying for ETFs. People are already trying to get it through the Clarity Act and all of these different changes for exchanges. But the entire point is that it has become the one-stop shop to be able to add value to the US financial system. And it is totally, I've written articles about this, but it's totally flipped the script because everyone in crypto has become such a degenerate that they don't even think about adding value to the system.
Hey.
All they think about now is how can we get our bags pumped? But when you are like Jeff and you say, oh, instead, why don't we think about how we're adding value to the system? Then what begins to take place is capital finds you. Instead of saying like, well, we need to get our coin listed on an exchange, get an ETF for it. We need to, have that happen so that it can pump it. Jeff flipped the script and said, how do we actually add value to the system and solve a problem that no one else is solving? And I wrote an entire article on this on January 16th, where basically every single crypto influencer has become so obsessed with just getting whatever crypto token they got an allocation to onto some exchange. And what has taken place is that they only talk about the coins that they have an exposure to. And that's actually why you don't see a lot of influencers talking about Hyperliquid, because they didn't get an allocation on the front end. They didn't get, some type of VC funding where they got to buy into it. And so that's why you don't have these guys talking about Hyperliquid, because it's not advantageous for them. And so the entire institution, the entire establishment that has taken place in the crypto space, all of these accounts and podcasts, they don't want to talk about Hyperliquid because they don't have an allocation to it. But the entire point is that the Hyperliquid team and everything that they're building adds so much value that it has provided uncorrelated returns to Bitcoin, the S&P, and every major asset in the world because of the value it's provided. So they have basically risen above the system, which is why Hyperliquid has actually deviated from the price of Bitcoin. I mean, there's a reason for that. It's not just random. And so, when you see Hyperliquid up this amount, up 90% from the lows, while Bitcoin is down 12, that sends you a signal about the value proposition that exists. And so right now, if you are in the United States as an institution, it's functionally impossible to buy Hyperliquid, hence why we have PER, which is the largest Hyperliquid and functionally, I would say the only. I mean, there's other small ones, but they're just not really comparable right now in terms of their positioning. this is the one-stop shop for institutions to get exposure to Hyperliquid, which is why I'm long this instead of the Hyperliquid token itself. And I actually have more exposure in PER than the Hype token because I believe there is more upside because it actually is going to trade, in my view, at a premium as we move into regulatory acceptance for this, for Hyperliquid itself. And so the entire point, people ask me like, well, why buy this instead of the underlying Hyperliquid token? Because you get the regulatory arbitrage premium from all the institutions that can only front run it in PER. That's why I'm long PER. And so the entire thing that I've been laying out is that when you have that dynamic, that is why you can have, value added via PER. And you can see here on James's screen, you have the premium versus discount on PER in the indicator that I shared. If you go back to the article that I shared on Hyperliquid and the right here for February 11th on my website, you can get this exact indicator that James is sharing right here. And we're at a little bit of a premium right now, which actually shows what? That the entire strategy is working. And so my view is that PER is going to move much higher, and that, and this kind of goes back to my original question for James, is I've had people say to me, and I kind of said this previously, oh, I didn't buy it when we were at lows, so I might as well just not touch it. What would you say to someone who just says, well, I didn't buy it here or here or here, I'm just not going to touch it now?
Don't. No, I just think like you got to reapproach, like, okay, you got to, it's easier said than done, but it's like what's done is done, right? Like how many times have we been through where like you see somebody that got in at some price of something and you weren't there? Like, are you going to live your entire trading career just like feeling salty about what could have been? I think you need to kind of adjust right now and start fresh and thinking, all right, here's where we are now. Let me go learn a little bit about Hyperliquid, about Jeff. I'm going to go watch all the videos and the thesis. Maybe if I'm not in America, maybe I'll explore the ecosystem. I'm going to look at the chart and say, what would be the areas where I could have the risk reward that sits well enough with me? What are the expectations still left in this trade? Now, is that something I want to take? If so, well, this is my trade now. And here's where I'm entering. And here's what I'm thinking about it. Doesn't matter where Global Flows started thinking about his thing, or some person, that is a subscriber got their thing. You need to address it from where we are now for you specifically. And if that doesn't sit well with you and you're going to get frustrated if there's another 15% pullback or whatever, and you just can't handle that, then okay, maybe you just follow along, you learn about the price of money with Global Flows stream. And the next time we find a large asymmetric macro bet, you'll be able to get in there at the price you deserve. But for now, there's no reason to kind of like come in here and talk about what could have been, because like that's going to happen perpetually throughout your career in markets. So there's no reason to really focus on that.
Yeah, I think one is to your point, if you were a subscriber on the Substack, that's the entire point of being a subscriber. You get everything early. But the other thing is, I'm always thinking about risk reward, not did I buy it at the low or the high. I mean, just think about ES, right? Like if you were, you have to think about where could the price go? I mean, just think about someone who goes, well, like let's just play out a couple different scenarios, right? You could be the person, if you're using this mindset of, well, I need to wait for a pullback to buy. That might reward you when you are, if you're in a period of time where you actually have dips or something like that, that's great if you can get that, right? But if you are right here and you say, you start looking at ES and you say like, well, I want to get long. And you say, yeah, you know what? It just moved up a little bit. Let me wait till it comes back to my price target. And then it just keeps ripping and keeps going up. And you just say, no, I'm just going to keep waiting. I'm just going to keep waiting. And then it gets here And then you begin to say like, okay, well, I'm just gonna keep waiting. And then you say, okay, it's the next pullback, then I'll buy. And then, we begin to pull back and you say, oh, wow, here's my pullback. I'm gonna buy. And then you just hold it. And then you go through a drawdown for, multiple months or something like that. That type of mindset, right? You want to think about where is the trend and how can I get on sides and how do I adjust my exposure instead of out of insecurity say I don't want to buy a high or I only want to buy this or I only want to do this, right? I think if you have a certain trading style, that's fine. But for me, like I'll give you an example is like, in this period of time right here when I've been running some trades in ES, we had this initial bid, which I've, talked about on the Substack, and I was, running some longs for. But then we had a gap down, and I said, oh, great, I'm just going to buy some more. If you had the mindset of, well, now we're above the lows right here, so I don't want to buy. We're not down here, even though we're at the gap here, so I don't want to buy. I mean, just think about your view should be about, is it going to continue going up? Not, is it back at this level right here? It's all about where is the risk reward now, because the risk reward is always shifting. And so I just think that's such a critical thing, because then you're just going to always be artificially anchoring to like your cognitive bias about fear of missing out or fear of whatever it might be, instead of what is the risk reward that is not yet to be realized, and constantly orienting yourself around that, if that makes sense.
Yeah, and one more thing is like that I think people get caught on a lot, and I find myself doing too, is like, let's say you go through that whole process and then you decide, hey, I am going to get in this trade at this specific area, and it comes back and you do get in the trade. You need to really have your risk baked in the cake, because like if you see a pullback, like let's say in this chart you have up, you were like, all right, you know what, if it pulls back to 550 to 540, I'm gonna get in. I'm not gonna chase it, I gotta wait, whatever. It comes back, you get in. You need to have your own risk determined, because like if you start to get off sides and you still are thinking, well, I know these guys are all still in because they're on sides, so I'm not going to puke now because they're all still in. You're making the same mistake in a different way. And now your downside is massive, right? So like you need to still be okay with the fact that like you got in, you got off sides and stopped out of the trade while everybody is still in the trade and on sides. Does that make sense? Like you need to be okay with that still happening and abiding by your process. And if you're going to let any of those external factors of other people's positionings impact your own execution, like you're off your rocker. Like that's not a way to approach trading. So I just be very careful with that.
Yeah, I agree. I think that, again, it comes out of operating a principle and process. And here's the thing that I always think about for trades, like for Hyperliquid right here. Let's say I'm a trader and I'm like, hey, I just like kind of maybe that there's an upside right now, and I just want to trade per round or something like that. I don't have the same conviction, but I want to trade it around. All you're trying to do is say, how do I get on sides? So all I need to do is say like, okay, there's an interesting level right here. We, up here is when we traded at a premium relative to hype. So if hype is in this range, how do I kind of understand these shorter term oscillations driven by the fair value indicator that James shared and that, I shared, right here. Again, go to February 11th, go to their website. You can update the tokens and everything like that. And, begin to say, okay, well, all I need to do is get on sides. And this is where, someone who is really good at managing risk or understanding some of these shorter term moves can really make money. Because let's say you say, okay, here's my risk reward for a short term trade on per. I think we're going to $10 and I'm going to put my risk at, let's just say 530. And then you say, okay, I'm going to risk losing 10K. 20K, 30, whatever it is, whatever the number is for everyone. And then my upside is that, we hit 10 and I, make whatever amount on that. Then from there, if we hit the profit target, then you can just say, okay, I'm going to move my stops to break even, or I'm going to roll up a little bit and wait. And a lot of times, if you know how to get on sides, you can get more exposure on than you would have just buying the low necessarily with smaller size. And this is really where, if you are, have experience and you have the reps and you understand what's driving markets and these shorter term moves, and you adjust your positioning correctly, then you view everything as a series of trades to get on sides. And if you just say, okay, like, how do I run risk here to just get on sides? And then how do I run another trade here to just get on sides? And then here, and then here, and then keep rolling my stops. And then you end up having a large position. Sure, you have vol, right? And you need to manage how much exposure you have. But if you're protecting your principal constantly, that's the key. And I think I always view the exposure that I have as a series of trades that are, connected yet at the same time independent. Because maybe I'll just take off a little exposure. Maybe I'll put on a little exposure. Depends on how you want to function. For me, my entire goal is to get exposure on sides. I bought in the lower area, and I've held, and I haven't sold any shares. There's a couple other times that I've put up some additional exposure, but overall, I haven't explicitly sold any shares, and I don't plan to, because I want to ride my winner. Someone might have a different position on that, and that's totally fine. My entire goal is to lay out the thesis and the idea, and I think this will dovetail into the stream and the slide deck that we have, which is all about how does this idea of hyperliquid connect to the larger macro context of the quantity of money in the system, interest rates, and these larger changes taking with the AI CapEx build out. Because I think that's going to be really key as we think through what is driving markets right now. And so that's really what I want to dig into. James, any other things you should feel like we should touch on before I dig into the interest rate side of things?
No, I just suggest, since we've been going over it each time, just let people know one more time where to find the per premium charting tool, and this one, if you want to share my screen again, this one is the Oracle. We talk about Oracle and per a lot. You have I just switched the settings here to make it back to the specific things, but having these up each time you come here is going to be easier for you to reference and understand what we're talking about. You see how I keep it tabbed, right? I have the per model, and I have the Oracle stuff right here, so we can reference it each time. And of course I have GameStop, because watch out.
You just never know. You just never know.
You never know. You never know. You gotta keep teasing. Gotta keep teasing. But I just think it's good for people to have this up.
Yeah. If you were, let me put this in the comment section right now. And then I'm also, right here.
And guys, like, if you just look at, this Oracle setup here with the yield curve regime, plus the like fundamental subsector flows, the broader market, fundamental flows, like, this is going to help you understand the price movement so much better than just looking at a typical candlestick chart, right? And you're going to add or subtract conviction to your positions based on this. Like, look back at what happened with all of these flows going positive for Oracle back in was this April of 2025 after the tariff tantrum. I mean, look at this run that it went on, right? When it went on its big spending spree or whatever, and all the expectations were pulled forward. Look at the flows that came in through that sector and fundamentals. We're just starting to flip that positive, and not even really like a fundamental sense yet, right? So the potential, you could just see the potential that's still there.
Yeah, I totally agree. I put the in here in the link, and then also, if you want to go over the specific one, it's on April 14th. So go to April 14th on the Substack. If you're watching this live or you're watching this later, go to April 14th on the Substack, my largest bets in the crypto cycle. And I explain where we are in the macro regime, how it connects to the trades that I'm running, the specific trades that I'm running as my core positions, which is per and Oracle. And then I give you every single model and article I've ever written on either of those, so that you have everything. So if you come to me and say, like, well, how do you think about the price target for it? Whoa, go through the article. I literally lay every single thing out. And I give you all the models, all the videos, all the breakdowns. You can also go through all the live streams that I've done. I almost at every single live stream, functionally 99% of all live streams, I talk about Oracle and Per because I'm super clear about my positions, right? If I lose, if you know, I'm my entire goal, and this is the same with James. We're here as risk takers. Our entire goal is to take large asymmetric bets in markets. If we are wrong about something, we lose our own capital. And you want to align yourself with people who are risking their own capital and intentionally iterating. Because here's the thing. I mean, at the end of the day, it doesn't matter if you are an investor who's investing in something for a 10-year time horizon or you are an intraday trader or whatever it is. If you have a thesis, you should always have a situation where you're wrong and you have to get out of that. It doesn't matter. I mean, even if you look at Warren Buffett sells companies, right? He buys companies that he tries to never sell, but there's positions that he takes off, whether it's for cash or for whatever else. And so, the entire idea is that there are situations where you can change your mind or the thesis might change. And that's why, if the thesis changes, I mean, like I'm not, Larry Ellison isn't paying me to talk about Oracle, right? There is no payment that I get except my ability to trade Oracle itself. And so coming on and saying, okay, what am I risking? How am I thinking through this? And laying out the thesis so that you actually have a clear view into what's taking place, why it's taking place, and all the tools to map it in real time. And you can come on the live streams every single day so that you have an update about what's taking place. I mean, that's the entire goal of every single thing here. Because James and I the thesis could change, and we say, you know what? There's actually a better opportunity now. There's a new thing. The thesis for Oracle or Hyperliquid or Per changed, but right now the thesis on both of them, especially on Per and Hyperliquid, is so strong. I mean, I'm probably more bullish than like right now, not just because of the price. I mean, the price, is whatever to me, in the sense that it's confirming the thesis, but the amount of things stacking for Hyperliquid and Per is just so extreme in my view that I think that Hyperliquid and Per just are likely to trade just so much higher from here. And that's my view. I think that Hyperliquid is probably going to hit $150. When is it? I don't know. I think it's one of those things that's very likely to happen sometime, hopefully this year, maybe next year, but I think it's going to happen this year. And I think if that takes place, I think trade at a 2 to 3x multiple to the MNAV, and you could have a massive melt up scenario, especially as we have all these IPOs moving into as capital moves across the risk curve in the credit cycle that we're talking about. So there's just so many things that are stacking up kind of in the pages of the book that James talks about.
Yeah. And one thing, I don't have it right here. Maybe I could go to their Twitter account, but like there are things on Hyperliquid that, not even this, but like there are things on Hyperliquid that people don't even know about, which one is like vaults, right? That's one. But think about prop trading. A lot of people that are watching here probably understand what prop trading is, right? They've heard about it. They go trade their little mini NASDAQ. I got to prove to the thing that I'm a viable trader and I'm going to get funded with a 50K account, blah, 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 blah. That's coming on chain. And if Hyperliquid, there's already a couple, you could go search on X, like Proper Trading, PROPR, right? They're a prop firm that is coming on chain, hosting on Hyperliquid. All execution will be done through there. Now imagine if all of these are going to be created and basically built on the Hyperliquid ecosystem, bringing on thousands and thousands and thousands of new traders. Like this is where Clarity Act comes into play. And all of a sudden you have more and more participants, more and more execution, more and more fees, the buyback ecosystem. Like these are like hidden little catalysts that even provide more opportunity for Hyperliquid to become a, number 2, number 3, on-chain token, right? Which it's not even even sniffing that right now. So keep learning about it, whatever. And if you want, we can we can move on to the actual topic of the day.
Yeah, I think that covering these is always going to be important. And one of the things that I would say is that if you're just getting onto the stream right now, definitely watch this first portion that we just went through, where we talk about the big thematic bets that we're taking and how that connects. Give me 1 second, James.
Yeah, so while he's fixing that, if you guys want, just go search that, and you could start to learn. Like, I mean, if you want listing this, like perps, prediction markets, HIP-3, bringing all real world assets on chain with competitive people fighting for liquidity, prop trading, vaults, meaning people can start like effectively hedge funds online that people can buy into and fund. That's all there. I mean, they're doing a great job at wanting to actually fulfill. And sorry, I forgot the pre-IPO thing, right? And by being able to buy spot stocks, not just leveraged perp trading too. So pretty amazing stuff.
So thanks, James. The place that I want to take things now is where we have the breakdown for the macro regime today. And how does all this connect to hyperliquid? I just can't tell you how convicted and excited I'm about for how interest rates connect to hyperliquid, because interest rates, everyone knows, if you've been following me, interest rates cause the rise and fall of nations. They are connected to everything. And when we think about interest rates, especially for the United States, the dollar is the global reserve currency asset. If you have the ability to globally trade interest rates and have very efficient leverage and size up really significantly, you can have so much more money move on to hyperliquid in a very similar way to, stable coins. People talk about stable coins, and the reason why we have stable coins is because you have the entire section of the world that uses dollars for global trade. And so there's this entire demand for dollars in the system that we're going to kind of cover today. And so if you understand interest rates, you are going to understand how every single asset fits into the financial system, why they operate in the dollar system that we have in the world today, and how all that connects to the credit cycle that we're in and the macro liquidity environment that we're in. And so, again, if you were following, people who are talking about, oh, well, liquidity is about to go off a cliff, or there's about to be a recession, or, there's, delinquencies happening in the underlying economy or something like that. Again, the entire goal is, well, what's the proof for that? What's the data behind it? And how do I think about the data? Because everyone has all these charts that they throw up, and you're just like, does that really represent what's happening? People will say like, oh, consumer sentiment is in the lowest it's ever been. The real estate market's beginning to blow up. And then you just go out to dinner and you're like, these people seem like they have a lot of money. And so the entire goal, especially for macro, and I think especially what I'm doing, is saying, how do I break down every single data point, correctly weight it, and then interpret it properly? Because then if you get that, here's the thing. I just think if you're looking at data and you're saying this doesn't line up with the world, you're either misinterpreting the data or you're looking at the wrong data. Very simple. So if you have a view and you're saying, oh, I think this is going to happen, and it doesn't match up with markets or the world around you, then you are just not understanding the system correctly. There is no evidence to say like, oh, well, the market is disconnected from the economy or something like that. I mean, that assumes that the market is supposed to reflect the economy in the first place, or some type of fundamental measure or something like that. And in reality, there's a reason why. It's not just irrationality. It's because of liquidity in the system and interest rates. And so that's what we're going to cover today. This entire slide deck will be laid out afterward. So if you want to have this entire slide deck, as well as all of the papers that I reference in this slide deck. You can download them all at capitalflowsresearch.com afterward. Again, all of it's here. You guys, I mean, if you can't find the link in my bio, we have bigger problems. All right, so we're going to start with rates. And rates are about the price of time and money. Every single slide that I'll go over here, I've put an SSRN paper that explains how to think about this. So if you're a person who says, I really like digging into the nitty gritty of how these things work and understanding the logic behind them, then you want to download that paper. If you're a person and you say like, oh, well, I'm not as much of a technical person, but I really like visuals. That's kind of like James. You just, you like the visuals of things. What you do is you go to this SSRN paper, download it, put it into Claude, and say, visualize this for me. That's what you should be doing. If you're a non-technical person, you're like that guy who's like the bearded guy who is like, I have no technical proficiency whatsoever. The like meditation guy.
I don't know.
There's like some meme where it's like he's like, oh, I have no technical skills at all. He just like knows how to like he just like helps people like breathe and think or something like that. It's like a meme that goes around all the time. Yes, Rick Rubin. The Rick Rubin guy. He's like, I have no technical proficiency whatsoever.
It's like he has taste or something. I forget what
he has taste. Yeah. If you are a person just who has taste, think about what the other people who have taste are not doing. They're probably, and especially in markets, they're probably not taking these SSRN papers that all the nerds are using and saying, hey, just visualize this for me so I can begin to understand it and give me an educational thing on this. And I would just ask Claude, give me an educational breakdown in an HTML file with dynamic visuals explaining every single dynamic of this idea. And that's literally like the entire goal of what we're going through. And so right now, when you think about 10-year nominal interest rates and where we are today, there are two things that feed into that: the price of time and then the price of money. And simply put, you can kind of go through what that means exactly, but it is, what exactly is inflation in the economy, which represents, well, how much do I have to pay to get stuff? That's all inflation is. How much of my time do I have to give to get the money that allows me to get someone else's time or someone else's good and service? And then what you have to say is, okay, now that we can understand like inflation, what that is, and for example, the PCE print that we talked about yesterday, and the fact that crude prices are down today, now how do I connect that with the price of money? If I want to borrow money from someone, that is impacted by the FOMC decision and how that feeds into dynamically the 10-year nominal yield. And so these two factors feed into how exactly the system works. And so you always want to ask, well, what is the price of time that I have to pay and the price of money in the system? Everything else is built on top of this. And so, for example, I'll give you a very easy kind of tangible example of how this works. Here in red is the effective Fed funds rate, whatever they do. Now notice that everyone's very anchored to the Fed, but what you want to understand is, how does everything revolve around the Fed? How does inflation, interest rates, and everything else change as the Fed makes their decisions? So you can see here in the orange, you have the 10-year inflation yield, right? And you have inflation swaps kind of moving in lockstep with that. And then in blue, you have the real price of money, which is the real purchasing power of whatever that might be. And you can tell during this period of time, we were negative in real yields. So that means that if you were holding cash, you lost money every single month if you held cash. And that's why we had one of the largest melt-ups in US history, because you actually were punished for being conservative. You were punished for being patient or, saying like, oh, I'm just going to hold cash and not do anything. And that's why there's a reality distortion field in sentiment when liquidity expands in the markets, because nothing seems right, because all the people who are smart and conservative and holding cash begin to look really, really dumb. And all the people who do really dumb things start to get paid a lot of money and nothing makes sense. All of that is reflected in interest rates. And so if you're saying, well, now sentiment is so hard to read because everyone's trying to psyop everyone, and I don't know if I'm in a silo of knowledge or not, and I actually need to connect it to the macro system. The way that you do that and the way you quantify those changes are through interest rates. And so across history, interest rates are the single variable that determines which nations rise and fall. Every hegemonic transition, you have the British sterling, you have American dollar, you have turned on funding costs versus growth costs. So just imagine what's funding cost versus growth cost. Just imagine in your life if I give you a mortgage at 6%. That's fine if your income remains at the same level and you say, oh, I'm making enough money, I can cover that. If I begin to bring your income down a little bit, then you start getting squeezed, even though your interest rate hasn't changed. And so it's not about what is my interest rates on an outright basis. It's about what is my interest rate relative to my income. Because you could have someone who locked in a interest rate at 2.5%, and if their income goes off a cliff and they can't cover it, they then have to liquidate their house. So it's about what is the price that I'm paying, the funding cost for debt, relative to my growth rate or the income that I have. And so when you have a hegemonic cost of capital exceed its real growth of rate, so when you have basically everyone in the interest rate market charges them more than they're making every single year, the rest of the empire arc is already basically determined. And that's what we see in the rise and fall of these different things. When you have large debt overhangs and these large changes, that begins to put a lot more pressure on every single country in the world, and they want to begin to take advantage of that. In the same way, if you see if you see someone who is basically about to go bankrupt and they come to you and they say, hey man, can you just buy my car off of me? I'll sell it to you for 50 cents on the dollar. They say, yep, I'll buy it right away. And they just take it. And then what you begin to have is you just have sharks surrounding, and you say like, oh, hey man, are you gonna sell those baseball cards? You gonna sell that Rolex that you have? You gonna all these other things? Then you begin to have people circle and try to take advantage of you, and they say like, what would happen if we just maybe pushed him over a little bit? Maybe he'd be more inclined to sell us that, and he'd be in a worse position. That's what happens in major countries on a kind of more subtle basis, and they're all through geopolitical type events. And so, if you're trying to dig into that more, go through this SSRM paper. There's a different one for each slide that I have here. You can download all these slides on the website as well. And so, you have these different periods of time, and now we're in a period of time where we have the US dollar as the global reserve currency, and that is why we have such high debt levels right now. And so when you think about modern sovereign yields, what has taken place is because the dollar is the reserve currency of the world and everyone is trading in dollars, every single interest rate in the world across every major country, US, UK, Germany, Japan, has actually gotten leveraged to the entire system and the same cycle. And, this, if you think about pre-globalization, everyone kind of did their own thing. A country might go through a recession on their own and then come out of it and they'd be fine. And then you have all of these different countries doing their own thing. But once you have globalization and this new dynamic with trade, interest rates all move in lockstep. This is why when someone says to me like, oh, well, I have a view on the US, but I don't have a view on Japan or Germany, or I have a view on Germany or Japan, but not in the US. It's like, well, then you don't understand how all of these countries are now cross-collateralized. It's like you come onto a betting market and you're going to bet on a race, and it's like what are the races where you like tie two people's, like, I don't know, you played them in like school where you tied two people's ankles together and like they ran together at the same time, and you're like, oh, I only want to bet on one, not the other. What is that called again?
Yeah, kind of like a weird potato sack race, but with another person. Yeah, I mean, I don't know what kind of school you went to, but
I didn't go to school. That's the problem.
Went to the school of hard knocks, folks. That's what he did.
The ironic thing is I didn't. So you basically say like, oh, let me bet on one person, but not the other, and you're like, well, but they're literally linked together. Their outcome is kind of connected. And you're just like, no. Like, I think something's going to happen. And well, this and that, right? Like interest rates the fact that they're all converging right here is in itself an indication of the world that we're in, which is all about how everything is collateralized to the dollar and global trade. And so the dollar is not just a currency. It is the operating system the rest of the world runs on. Really key thing here. That is where we have now 50% of global trade is invoiced in the dollar, probably more, by the way. 58% of FX reserves are in the dollar. And then 70% of emerging market hard currency debt. Again, these are all conservative estimates. You can go through these SSRN papers and kind of go through the specifics of them and where there's trade-offs. But broadly speaking, you can argue about maybe some small changes in those numbers, but everyone agrees on the larger reality that these exist. And so that means that you have everything connected to the dollar. So if you have changes in FX, changes in safe haven, emerging markets and corporate debt in emerging markets beginning to change, or changes in things like tariffs or the euro dollar market or trade invoicing, those are all linked to the dollar, which means if any of these things move or the dollar moves, that reverberates across everything in the entire system. And so when you think about the dollar, you need to think about the dollar against what? The dollar against the DXY is, against major currencies, and it's primarily the euro. But, we've been in this period of time where you had a stronger dollar and you have this level in 97 in the DXY, and then also dollar strength against the yen. And then really over the last years, the dollar is still pretty strong against the yuan. We've come down a little bit, but we're still in a pretty high range. And so the idea here is that we have a strong dollar in the system, which every other foreigner in other countries takes advantage of because they say, oh, the dollar's strong. I can export a lot and get paid a lot to the US. And that's why we have this entire idea of the current account and capital account, that the US fiscal deficit is mathematically a foreign savings surplus. What does that mean? It basically means that one of the reasons why we have so much debt in the system is because of the dollar. I would actually say the reason why we have so much debt in the system is because of the dollar's reserve currency status and other countries taking advantage of that to basically export to the United States. And so if you want a great book on this and try to understand this a little bit more, you want to go through Michael Pettis, Trade Wars or Class Wars, or any of the other books that he has. But most countries export to the United States and buy US assets. And as a result, that causes a ton of liquidity to flow into the US, and that allows them to issue a ton of debt without blowing up the US bond market. And so these things are all of the underlying mechanics that undergird this idea in the market that we're always able to issue debt. Stocks always go up and to the right. But why is that? And a lot of it is connected to the global trade and the dollar reserve currency status, because this goes back to the idea of, the US has been able to bail out the banks in 2008 and the consumer multiple times and has able to backstop the system, and they haven't caused the dollar to totally incinerate. I mean, if you think that the dollar has gotten incinerated, you should go look at like countries where they have an actual balance of payments crisis and the entire country collapses and civil war ensues. Like, that's what happens when a currency collapses. Like, all things considered, the US has done pretty good over the last, 40 years, 50 years. And it's because we've had this backstop of the dollar. And here is the US current account in blue. So this is the US importing more than they're exporting. So when you have this line going down, the US is importing more than they're exporting. And, we had a massive move down during COVID. And so the idea is that when you import more than you export, you give a surplus of dollars to foreigners who then take those assets and put them in US denominated assets, which is why one of the largest risks to the United States is if you have foreigners sell US equities because they need to raise dollars, which is exactly what they did in 2025 during the tariff tantrum. So this idea connects to fiscal dominance, where treasury issuance connects to monetary policy. So at low debt, monetary policy sets inflation. So when there's not a lot of government spending, it's all about the central bank. But when you have a lot of debt in the system, then you have the fiscal side be one of the main drivers. And this goes to the kind of the net expense, interest expense. So how much is the US paying other country, or excuse me, debt holders, and how much is that as a percentage of their outlay? So basically right now, the government spends so much on interest payments because interest rates are so high. And so, net interest payments in the United States are already approaching defense spending, which means that we're spending as much on interest rates and our debt service as we are on defense spending. And we're beginning to approach this larger picture of what are we going to do with the U.S. debt situation. And the U.S. is primarily operating, the way that they're avoiding some type of blowout in the bond market is by issuing more short-term bills than long-term bonds. When they do that, it begins to allow more money in the system. And what begins to occur is that both the monetary side with QE and QT and the fiscal side with GDP are both now moving around inflation a lot and nominal GDP. This is one of the reasons why, going back to this original chart on interest rates have broken their long-term trend right here because of this entire government spending and these higher interest expenses and all of these things culminating at the same time. And so it's not just we're just in a unique period of time, we're just going to go back down for a little bit and then everything's going to go back to normal like we were in the 2010s. So that's not going to happen. The mechanism in the system doesn't exist for that right now. And so when you think about federal debt held by the public, it's only been going up and to the right. And then the implied annual debt service burden, it's only been increasing as well. And so the idea of people talk about term premium is waking up, which means if the government is beginning to have issues with the currency, and that's reflected in interest rates and things like that, then people want a higher premium to buy bonds, which is this entire idea of term premium. And it's having it all at the same time, which is why interest rates are all moving in lockstep. This is duration risk, not growth or inflation risk itself. It's connected to inflation risk, but it's not inherently growth risk. So this all connects to the global kind of temper tantrum that we've seen multiple times, where once governments try to issue long-term debt, the market doesn't like it. And so they're saying, okay, let me just issue bills instead. This is the volcano and the idea that once you have changes in these underlying things in the system with real interest rates and inflation expectations, it begins to, it's underneath the surface, it's boiling, and it can cause a massive explosion when people really least expect it. And the problem with the financial system today, and I'd actually love to hear James' thoughts on this and how he kind of connects this to trading. The global financial system today has become a place where there's a lot of people who have become the boy who cried wolf. And what you see is a lot of the bears out there. They talk about some of these things, but they don't connect them to markets. They don't take risk with them. And you have all these people who say, "Oh, I called the global financial crisis, and I knew it was happening," and blah blah blah. I mean, the only reason why there's respect for Michael Burry in the world is because he actually made money off of it. He wasn't just, "Oh, I was a strategist who called the financial crisis years before." It's like the S&P kept going up, bro. Like, all of us time everything in our life. All of us time our rent payments, our mortgage payments. Like, if you can't time the cycle, it's not really worth anything. And so the idea is that everyone has kind of become the boy who cries wolf, and no one really understands how much volatility is building under the system because they're not connecting it to markets and these changes in interest rates and macro liquidity, which is why my entire view right now is that we are in a credit cycle melt up. And I think we're still going to continue to move up in equities. But my entire goal is I map all of these changes to the actual price action. And when the shift actually occurs, you'll know that it's not just a positioning unwind like we had right here, but it's actual structural change. So, James, how would you think about kind of that tension where you have all these people kind of have become perma bears or boys who've cried wolf and no one really trusts them anymore? And you kind of now they've just kind of turned into fear mongering and not risk takers, but that understanding underlying risks and how they connect to price action is actually the important way to navigate in the world that we're moving into, where there could actually be some really massive trades that you could take that can make your career.
Yeah, I feel like that disconnect between understanding what is the driving force is, you can maybe get away with it sometimes when your timing lines up, but as you move through time, that disconnect becomes impossible to just like, you can't lead on it, you can't trade on it, right? So I mean, Burry, shout out to Burry, by the way, shout out to Burry. I like, he was able to take such a large building a large position, but then it kind of all like culminated in a moment that kind of also worked out. But I think people look at it in a vacuum as he was able to kind of perfectly time something, and they want to reimagine that. But I mean, the bigger story was, I mean, what was he in that position for? Almost a year, maybe longer.
Yeah, I think so. Yeah.
Hundreds and hundreds of millions of dollars, a lot of pressure. I mean, probably felt an insane amount of regret and questioning himself along the way before it all kind of toppled over in a way that kind of worked out. But I think people think he did it in a pinch and kind of shorted the market when it was like the right time to do so. And that's just, that disconnect is going to, it's just hard to rely on, like timing and luck and all that. So it's just I think a better way to approach this is bottom up, kind of through your work, and then trying to kind of time execution based on the speed of the regime changes or where we are or whatever. That's the best way I could explain it, is that like if you're just relying on small moments in these long tankers worth of shifts in policy and macro flows, like it's going to be a tough slog for you.
Talk a little bit about the reps that you've had and how you feel more or less prepared for the next crisis when it occurs, and how you think about reps in the seat that you've had and how they've prepared you, and how you've traded well or poorly or as well as you could have through previous crises, and how that's kind of set the stage for who you are now and how you think about when vol kind of pops back off.
Yeah. Well, one thing is, like, I think everybody has to go through their doomer phase, right? Like, I've been trading now since 2013, and I've seen a bunch of different crises, and I've seen a lot of, I mean, 7 times a year, we have a reason to think that a great reset is coming. And how many of those times has it actually prevailed and become something? Well, pretty much zero. Maybe COVID, you could argue, was the biggest kind of shift in normalcy or whatever. But over time, I've realized every time I've tried to position into something, every time I've thought I understood to the fullest extent some sort of thing that was going to come, it was always not rooted in anything but hope and misaligned expectations and stuff. So over time, my reps have like dulled me to the point where I'm like, okay, let me try to just see things for what they are, and I'm gonna rely on my experience to feel when things have actually changed. And you need to like go through a few different crises. Like, you need to go through a revaluation of the yuan on a weekend. You need to go through COVID. You need to go through a 2022 bear market. You need to go through Q4 of 2018 when they tried to raise interest rates and be hawkish. You need to go through a Volmageddon to understand the differences in the price action, and like, was it a structural break? Is it a fundamental change? To then decide how to act into the future better. And if you're just coming in now and you've just been trading the last year, imagine starting in 2024 when everything was going up and to the right. We had, big optimism, and then walking yourself into a war. You're probably going to think this war in the Middle East, once you learned about the Strait of Hormuz, was going to literally be the end of the financial system. And I don't blame you. Because it sounds like it is, right? 20% of the oil, the world runs on oil. Trump has lost all control. Israel controls the world, whatever. Insert whatever thing you want. We're going to get through it, and then you're going to have to look back and do a post-mortem on everything you felt and thought and acted on to then get into the next crisis, right? And decide kind of, how do I want to approach this one? How do I want to allocate risk? Things like that. So that's probably the best way I could put it, given my, decade plus through this stuff.
Well, yeah, I think that's good. And I think that it's one of those things where if you're trying to hedge your risk for unknown unknowns, there's like, I just don't even know what I would think through in those scenarios or those situations. That's why I think it's great for people to, go through your content or reach out to you and chat with you, because, that you're able to glean, especially from someone who has a lot of involvement and proximity to all these changes in markets and has, just had so many reps. I think it's always, I think the ability to kind of learn from those experiences other people have had are only going to serve you as you try to take on those experiences on your own. And so I think that's just one of the key things, right?
Yeah, and that's why I like to seek out people who have been around even longer than me. There's like this weird wisdom that people bring when they've been through crises that really help base you and help make things feel a bit more normal and help you approach things in a better, clearer fashion. Because if you're new and you're just talking to other new guys and you guys haven't really been through these things, and you think for some reason your asset is not impacted by the price of money and the price of time, you're starting off on the wrong foot. So keep meeting people that can help you through that process.
Yeah, before I go to the next slide, I'll say on a personal note that people, I guess, see this less, but the number of amazing people I've had in my life that pour into me a lot and that I still meet with. I mean, I met with, we were just talking yesterday about how I met with a good friend who's, way older than me and has way more life experience. And I just get to pick his brain. And some of it is about like business. Some of it's about life, but, meeting with people who have way more experience than you and being available and teachable and going through that constantly, like that's something I've done for just so long, and it served me so well. And you don't see all of the inputs into that, right? Where you get going and constantly, driving a couple hours just to go meet with someone, flying to go meet with someone just so you can have a conversation and benefit and then leave, right? Like no one sees all of that, right? And so I think it's been so instrumental in my own life and my own ability to, I think, operate at a higher iterative pace than like an average person. I think that's one of the key inputs that's been that for me.
Yeah, don't be afraid. Like I made a video on this about like building your network and stuff too. Like you could go to my channel and you just search like networking or something. But like I think it's just unbelievably underrated. And I go do a lot of things. We mentioned this last time, but like I'll go to a Bitcoin conference. I will go to a different state just for a couple days with the intention of maybe having a conversation that shifts my perspective, right? And if it does, it can help me so much more. Oh, look at me in the hot tub. So much more than I anticipated. And it might not look like something. It'll feel like you're spending money for no reason. But in fact, it's helped me make tons of money and tons of better decisions just by going and being in person and going back and forth and getting into deep conversations.
Yeah, absolutely. Go to James Rosenthal's channel and go to this top video that he has here on how to build your trading network. I mean, it's kind of funny because it's one of the most it's kind of funny. I mean, you have some amazing videos. I always feel like the best ones are the ones that have the least amount of views for some reason. And it's just like so underappreciated about like how to build your trading network, right? How to build, I mean, even if you're not a trader, how are you building the people around you that are going to challenge you? Because someone who is insecure and afraid of accomplishing things is never going to challenge you. They're only going to tear you down. Right? Someone who has accomplished a lot and they're secure in who you are and they see your potential, they're going to challenge you. And so, being able to do that is just something that is just so underappreciated in the world today, independent of markets. So I, encourage everyone, go through that, spend time going through that video and thinking about that and taking inventory. I think that'll be really good.
Yeah, and real quick, like on that last note is like, if you were to snapshot your group right now or the people you talk to the most, I really like it when I have some people I would consider above me, more experienced, more successful, that could pull me up through osmosis, through abundance, right? Some people at my level, so I could really like feel like people understand where I'm at. There's some people right around me I could relate to them, and then people that I could pull up and help. Right? It's like that kind of, you ought to be the average of the 5 people around you, and that will give you a nice, well-rounded look on markets, look on thinking, and I think that's important.
Yeah, totally agree. Totally agree. All right, so this connecting all of this back to kind of this larger environment we're in with interest rates, and if you're just coming on and you're going through all of the material, again, all of these will be laid out. We'll go through questions on the slide in a moment. So if you have questions, or if you're watching this on Twitter, whatever it might be, put questions in the comment section and put them in the stream section right here, and we'll cover them. Again, this slide deck will be available afterward at capitalflowsresearch.com. I send them out every day. The idea about where we're at is that who is absorbing all of the debt that we have in the system now, given where we're at? And the idea is that over the last couple of years, as the system has shifted, the marginal buyer is demanding higher yields. And that's one of the reasons why, if you have more debt into the system when inflation risk and nominal growth is still high, which especially with this CapEx spending coming into the system right now is taking place, that is one of the reasons why you have so much more debt entering to the system and why you have yields at these levels right here for the 10-year treasury yield. And so, if the Fed is still, this is why Warsh talks about the balance sheet of the Fed, because he understands structurally there's premiums and discounts in the market. And so if you have the amount of inflation in the system increase, you can have too much inflation, and that causes bear steepening that converts, basically you have higher interest rates that rise faster than the amount of growth in the system, which causes defaults. And here's the thing, with the amount of speed that's taking place in the system right now and the amount of capital flowing into this credit cycle melt up, there will be a moment where it begins to fall apart. And again, I'd go through these papers right here because they kind of explain some of the fundamental principles for how to think about it. But, one of the ideas is that credit cycles are reflexive. Easy money compresses spreads. Compressed spreads invite riskier issuance. That's where we are right now. Riskier issuance plants the seeds of the next default cycle. We are in a, you could say late phase, whatever you want to call it. High yield spreads sit near 30-year 30-year levels of tightness. You have a ton of private credit that's been untested. And I mean that in the underlying system that we're still not seeing default yet. And the trigger that converts this into realized defaults is either long end rates blowing out or likely some type of contraction in liquidity in the financial market from dollar liquidity. And so we move through these cycles But these cycles aren't about, oh, a growth rate cycle or whatever it might be. It's about liquidity and how that sets the stage for risk taking, and then how it can set the stage for defaults and things like that. The entire question is not about how do these follow each other exactly, but it's about what is the amplitude and timing of them. And right now, we are in a period where if we have bear steepening, it could cause some issue in markets. We're not seeing that right now. So, and again, I laid this out yesterday in the live stream where I also shared the model, and you can go through all that as well. And the idea here is that, we have credit spreads at cycle lows right now. And especially for investment grade, I think we're at just such low spreads. And we haven't had a true unwind of a credit cycle. Even 2016, we didn't have true defaults. 2020, we had so much money thrown at the system that it just pushed everything out so far. Now, the entire issue that we're dealing with, because the government keeps bailing everyone out, is about this currency side and interest rate side, because the government keeps backstopping the system. And so once that in nominal terms begins to deteriorate, that's when you begin to have issues, and once you have a recession. Right now, all of the signals are pointing for those things not to happen. And so that's the kind of the question that we're at right now.
Just on that last slide with the circular one with the "you are here," just to point out, when you're at this point in this quote unquote cycle, is this often where you can see some of the largest upside movement? Because it's kind of like the last hook in the system, right? The risky stuff, the thing
this
that
is where everyone gets over their skis. Yep.
Right. Yeah.
And
which we haven't seen yet necessarily.
We are at the beginning of this phase where the most upside occurs. This is the entire George Soros thing. Oh, there's a bubble? Let's go buy it.
Yeah.
You should go find bubbles and buy them all day. And you're like, well, I don't want to lose money. Go buy some calls. That's a position sizing issue. The most melt-ups occur, you want to be long during melt-ups. What happens is people say, oh, the melt-up is beginning, I need to get out, which is the dumbest thing, because the most upside in markets, imagine not being long in 2021. You basically it's the same idea of, oh, well, I'm too afraid to buy a house because all the speculation in the housing market in 2021 was just a bit too much. And now we're higher, right? And so it's about timing these things and understanding the factors around them so that you're able to have the upside and downside. That's why it's just, if you're just a doomer and you're always saying recession is coming, it doesn't really matter if you catch the recession. If you basically, if you're going to say oh, I called, if you're going to be, back down here and you say there's a recession coming, and then, we just keep melting up, and then you finally are the guy, even here, saying, oh, there's a recession, and then we finally pull back to here, and you say see, I was right, and it's just well, you probably made so much money on the upside. You could have taken a gain. Two,
can't see what you're showing if you're showing something. Yeah,
I need to get better at that. On the idea of this, if you're just the person who's been a doomer this entire time and said, oh, there's a recession that's going to come right here, and just have all these chops right here, and then you have this same person and we finally have a bear market and they say, see, I told you guys, or whatever it might be. And you weren't long during this period of time, especially right now, right? There's been so many people that have been so bearish this entire period of time, and they're just hoping that it comes back down here. When in reality, even if after you adjust for dividend payments and things like that, not being long on the upside is just as bad as being long through a bear market. Which is why you get paid so much if you can time both. And so, if you can get on sides through those periods of time, that's why it's so valuable to be a trader, because you can be able to, be on sides during that time, right?
Yeah, and I think one of the worst things that can happen, I've had a video where, maybe a video, I don't know, I've talked about this before, where basically one of the worst things that can happen is you get one of those calls right? Because if you call that 2022 bear market right, and you win some money on the downside,
Right.
you are now going to be somebody that associates and identifies with being able to call bear markets, right? So it's like when I say one of the worst things that could happen is if a trader just starts off winning a lot of money, right? Because they start to identify with being a winner, they get to skip the process that most people do. They understand things, they're a savant, and often they will have to go through this really long process of losing that all back slowly, cratering down, and then having to decide whether or not they want to respect the market, be humble, and claw their way out. Where, you'd rather like kind of succumb to losing first and understanding things. So one of the worst things that could happen is you get hooked in to being a bear guy who was right one time, right? You've seen it with a ton of people. So it's just it's a tricky mentality to have.
Yeah, I agree. It's it shows you why you need experience to deal with success just as much as failure. Because a lot of success can throw you out of the game just as fast as failure, right?
Mm-hmm.
I think a lot of this is coming to. I'm going to go through the rest of these slides a little bit faster, but all of this is coming to a moment where central banks are all a lot more coordinated, and you have yield curves moving at the same time, and you have a little bit of differentials. You have the BOJ exiting kind of their yield curve control. You have, some more changes with, the balance sheets and balance sheets differentials. But broadly speaking, when you think about all these central banks, they all, hiked at the same time, and they're cutting at the same time and pausing at the same time. And so that is going to, there's tighter and tighter spreads between all of them, which is making more and more coordination between all these countries. So everything moves more and more in lockstep, which means that understanding macro becomes more and more important. That's why I think people are realizing how important interest rates are, but no one has spent, years and years spending time modeling, understanding why they take place, having experience trading them. No one really cared about interest rates before 2020 because interest rates always went down. Don't you know? Interest rates always go down. That's what happens. And all the guys who traded interest rates in the 1970s and 80s, I mean, Paul Tudor Jones is still around, but you gotta realize people like Paul Tudor Jones, they don't exist anymore. There's no one else out there, right? That traded commodities in the 70s, right? Traded interest rates in the 80s and the 87 crash. No one was around in the 87 crash anymore, right? The majority of people, their claim to fame was the great financial crisis. And I think especially, there's still people around to do interviews that were maybe around in the 80s, but they're not trading still usually, just the majority of the time. So that's why I think, the fact that Paul Tudor Jones is still doing his regular routine on all this stuff is pretty wild still. So the idea that I kind of want to leave people with is the flows of capital is the only viable navigation framework in the world that we're moving into. So we're not in a closed economy. You cannot navigate 2026 with a closed economy textbook. And the capital flows framework is wiring and is the wiring diagram you actually need to kind of pull together all of these things of the balance of payments, dominant currency, dollar liquidity, term premium, marginal buyer, central bank dispersion, credit cycle, fiscal trajectory, all of those together. And the idea is that all of these things for the price of time, right? The arc of empire, the dollar, the balance of payments, fiscal dominance, and all these mechanisms connecting to the capital flows framework and the marginal buyer, marginal seller things, term premia, the credit cycle, all of these nodes, all of these elements feed into each other. And I've put these in here in a linear circuit board fashion. They're actually more like a three-body problem where they're all dynamically changing their weightings and impacting each other and shifting in real time. And so my entire goal for capital flows, and this is what I've been doing for, I guess years now, and on the Substack since I've started it, is sharing the entire process that I run privately and now sharing it with everyone on all of these changes that are impacting all these global markets across the dollar, rates, the curve, Fed funds, the S&P, credit spreads, and everything. And the entire goal is to map the macro regime and find a few large asymmetric bets and lay out everything in real time on Capital Flows Research. All of the paid section is for paid subscribers that goes in depth and shares all the asymmetric bets on the early side so that you can actually get positioned into them. And the entire goal is to break down everything so that if you were the type of person who says, you know what, I want to really invest and understand all of this, this is kind of the focus I want to have, then you're the type of person who says, I'm going to show up to the live streams every day. I'm going to go through all the research. This is going to be the main place that I focus, and I'm going to be all in on. And so that's the entire goal that I have. And myself and James are going to be doing these live streams every single day during market days and breaking down all of these factors and pulling together all the things that we're seeing in real time. And we're going to continue to do private. We'll be doing private live streams that break down a lot more in-depth proprietary stuff that I run for paid subscribers on the Substack, which is why you want to be a subscriber on there. And we're going to go through all the questions right now and talk through how to think about a lot of these factors that we just covered. So if you want to ask questions, put them in the chat and we'll cover them right now. And we'll talk about how you should really think about these different factors that relates to your personal situation. So we're going to go through some of the questions. If you're here, retweet this on Twitter so that everyone's aware of it. And then also we're going to go through these questions. And these are going to be great too, because, you know, I have people that come back to these sections of the live stream all the time. And they say, oh yeah, this really specific question that this person asked was really helpful. And it helped me build this other model. It helped me frame how I was doing X, Y, and Z. And so, you know, go through this recording, right? You can go through, get the transcript, you can do whatever you need and spend time building out things. And then again, on this entire slide deck that I shared, you can go through all of this, and this will all be linked at capitalflowsresearch.com. And then every single paper that I referenced, you can download as well. You can feed into Claude, you can read it yourself, you can do whatever it is. So you have every single thing. There's no excuse. You have every single thing that will allow you to be successful. You just have to put in the time and the work. So, James,
also, yeah, like if you're somebody out there watching right now and you're not a paid subscriber, do yourself a favor and spend a little bit of money to make yourself accountable. Spend a little money on yourself to become a better trader. You might be sitting there saying, he just live streams every day. Like, I don't really need to do that. Well, you're always going to be on the back foot of positioning into large asymmetric macro bets. You're not investing in yourself. You're trying, again, you're kind of thinking in a scarcity mindset. You need to become abundant. The fact that you can spend whatever it is per year to learn an institutional grade stuff to become better. If this is something you ought to be doing for 10 years, just think about it. You know, some of these bets might help pay multiple years over and over to support what Flows is doing, to better yourself as a trader. Just don't be afraid to invest. Don't be this person that's always trying to get the free tip, the free Twitter scroll, the free call by somebody. Try to operate a little bit differently. That's my suggestion to you.
I like it. The thing that I love is, you know, I think.
And real quick, hold on. Sorry. Yeah, the last comment on here is the perfect example of that. Lucas, investing in myself means paying you. I am not. First of all, it's not me. And yes, it's just a subtle shift in mindset there. Again, you're saying I want the rewards without you also succeed. It's not a rising tide lifts all boats mentality. It's a take. And I just think if you approach markets like that, if you approach life like that, it's going to hurt you and you will end up complaining about other things down the road. That's just my 2 cents. And I hope that could get through to some people.
Totally. Yeah. I think, I think the people who understand how the entire Substack and everything works and who have been have seen the progression and development of everything like that and how everything has gotten better, they understand, I'm never worried about that. And I think people are going to realize, I mean, I would encourage everyone, go get a Bloomberg, 30K a year, and go, if you want, hire people that can help you with development, another maybe 100K a year. Go ahead and start spending money on AI compute to actually run agentic models, probably another 10K a month. Go, start buying extra intraday data or other kind of like factors to make informed decisions about all these models. And then on top of all of that, go ahead and read all the educational primers on the Substack. There's a couple hundred books on there. There's a couple thousand papers. I would encourage everyone, just go do that and go build your own Substack and do it on your own. I mean, I would love that, because then I could just just subscribe to you and not do any of this stuff. I mean, that sounds great. So that's what I encourage you to do, man. Let's jam through some of these questions. I think these are always fun. How do you? Let me get this. All right. How do you take the macro regime and tie it to specific thematic bets? What is your framework of thought process when approaching that and identifying where to look? What you want to do is say, what is the largest macro changes that are taking place, and which bets have the highest sensitivity to those changes? So for example, the largest changes that are taking place in macro right now are connected to AI. They're not connected to crypto, which is why we are not seeing alts rallying, because there's not enough change taking place there. So you always want to say, what are the largest changes that are taking place? And then how are those mispriced? How can I stack on additional edge where I know something that other people don't know, or I have a different time horizon or risk tolerance than that? And here's the thing, like, just think about how every single thing is tied to GDP, right? Because you have Apple and their revenue. Their revenue is part of GDP. It's a percentage of GDP. Google's revenue is a percentage of GDP. And so all of these different companies in the world, they all connect to, in a bottom-up fashion, macro and GDP. The question is, which ones of those are changing the fastest, and how can I ride that trend? That's how I think about kind of this thematic idea. Anything you want to add to that, James?
No, just other than picture this process is starting as you're like trying to sharpen a knife, right? And you're trying to track from the macro regime and the change and speed of that down into the thing that's the sector that maybe is having the most impact, subsector, single stock, chart, execution, risk reward, right? Refining it all or compressing it into a diamond type of thing.
Can you pull up that tab you have for Oracle again?
Yeah.
This is a great example of how this works, because all you want to do is have a view on every single section of this: the market, the sector, the specific individual stock. If you spend here's the thing I would say: don't try to build a screener. Just spend time studying every single element of these, and the trades will come to you. Like, that's what I always do. I don't try, like, I have models that filter a lot of stuff and all that stuff, but at the end of the day, my entire goal is to spend time learning about different things and build a base of knowledge over time, and the trades will come to you. That's what people don't do. They always try to find one-off trades instead of building knowledge in domains or sectors. And that's why you're always going to be on the back, kind of the behind the curve a little bit. And you get ahead of the curve by developing knowledge across multiple sectors, domains, names, and being able to time those correctly. So I think that's kind of the idea.
That's the field of dreams approach. Now, I don't know if you are old enough to even know what that means. But there's a famous line in there.
What is that from again? I don't even think
it's a famous baseball movie. It's an American staple. If you haven't
I don't even watch
it
movies. It doesn't even matter. I don't even like. I feel like I do
patriotic.
Here's the thing, though. I watch more like. I feel like if I don't even have a TV, guys. Everyone knows, or James knows this at least. I don't have a TV, but I think that, like, if I do watch things, they would be older than the things that you watch. But then I don't really watch much. I don't know, I'm pretty out of touch culturally, no matter
Your
what.
volume's too low, so chances are I'm going to be right that you haven't seen it. Which
All right,
guaranteed
never.
has not seen Field of Dreams. But anyways, there's a famous line in there that is just, "If you build it, they will come." Right? It's
Yeah, of
if you
course,
build
yeah.
this baseball field, the people, the like ghosts of baseball's past will come. That's kind of what you're saying here. Is you build your foundation, and the trades will find you. You don't need to find the trades.
There you go.
Well, you got to
There
find
you
the
go.
trades, but you know what I'm saying.
All right, 2 cents year, 2 cents inversion leading to an equity pullback 12 to 18 months later. In recent inversions, is there a reason why? What I will say is that I just think this idea is like absolutely ridiculous. People who like say that never run risk. If you actually try to actually trade that, you're always going to lose money, and it's, I think, at best coincidental. And it's very one dimensional. This idea that yield curve predicts recession is just dumb in my mind. There's no evidence of it really. The yield curve inverting can indicate a recession if it's bull flattening, but if it's bear flattening, does it predict a recession? Because in the most recent bear flattening, it didn't, right? So does that then falsify the entire thesis, or are you just going to kind of like ignore other data, right? Like that's the entire
Yeah, we're going
problem.
to ignore it until it is right. That's
Yeah,
what we're
I
gonna
guess
do.
so. All right. Next thing, how the market participants, they set inflation expectations through into inflation swaps and decide how many cuts are priced. Then what's the Fed's role in setting rates and inflation? So here's what I would say is that the SOFR contracts price what the Fed is going to do, expected versus realized. At the end of the day, if the Fed allows inflation to run at 20% and they just cut rates still or hold rates, those SOFR contracts have to settle at whatever that is. They have to. That's their function. However, other like, you know, other like all the interest rates on the long end that don't settle as a derivative for SOFR, those will definitely move up. So it just depends on what that is. On the inflation swaps, those settle at CPI. So it just depends on what CPI is. What is the role of the Fed? I think the question is, what's the role of the Fed if the market sets interest rates? Markets set rates on the long end. The Fed usually controls the short end. And sometimes the Fed allows the market to push it around. And sometimes the Fed pushes the market around. But that's only on the short end, really, not on the long end. That's what I would say. All right. We are not going to talk about meme coins, but that's all good.
Well,
I mean, all right. What? Do you want to talk about meme coin? No, you know what? No, we're not going to, James. We're not. We will talk about meme stocks. We're not going to talk about meme coins.
don't worry, guys. He'll talk about meme coins when we're at the turning point of all of this. Then maybe we'll have.
That's correct, guys.
Right?
When you start seeing me talk about meme coins and being interested in them,
Yeah,
I will be doing that because I think the top is near.
that's right.
So it'll be like a reverse thing, right? I'll talk about
come
them.
back to this. We could come back to this stream.
Yes, I'm going to, yeah, exactly. Do you often take yield curve trades, betting on the change of the shape of the curve? Yep, pretty frequently. Depends on what it is. I sometimes it's better expressed and sometimes it's not. At the end of the day, a yield curve trade or a curve trade is a pair trade. You don't have to overcomplicate it. Sometimes they're great, sometimes they're not. Just depends. So, all right. Let's see. Other questions?
By the way, while you're looking, if you guys are coming over from my channel, which I see a lot, which is awesome, if you're coming over and you're kind of new to Capital Flows, I would highly suggest putting this in your YouTube arsenal. Go subscribe to his channel, go subscribe to his Substack, and start learning this stuff. Because I know I get a lot of newer traders, futures traders, things like that on my channel. This is stuff you're going to want to start working into your life. It gets really interesting when you get a lot deeper. So
yeah,
thanks for popping over.
I like it. Okay, so a couple things on these slides. They're just going to be PDFs. They're not interactive. But I mean, you can just build your own. Just ask Claude Code to redo it and build it for you.
Make this move.
Yeah. I'm just like, I don't know. Why don't you just do some work?
Make no mistakes.
Are you finding or planning to share other asymmetric trades soon besides Per, Hype, and Oracle? Yes, on the Substack, I'm working on some right now. They'll only be shared with paid subscribers. So if you're over there, you'll get them hopefully when I think the timing's right on them to share them. All right. Let's see if there's any other. I like selling puts. Any advice for hedging risk of recession? I mean, if you're selling naked puts and you're saying, how do I hedge my risk for a recession? I mean, you're basically doing the worst thing that you could be doing right now if you think a recession is going to be taking place soon. If you're selling just naked puts and just hoping for the best, you're just going to get body bagged sometime soon. Just especially with how vol blows out these days. If you're, collecting the premium for Vega and you're functioning like a market maker, sure. But, again, just this idea of just like selling puts to collect premium, again, it's fine if you know how to size it against a trade and against your position and things like that to properly collect premium. But just doing it and hoping for the best and saying like, oh, I just can generate yield every month and I don't have to ever like lose money. Like it's a perfect strategy that works really, really well until it literally blows you up. So,
is it the point of selling puts too? I'm not an options guy. Is it the point of selling them to be okay with like a large drawdown? I mean, I guess it could be a hedging exposure too, but you theoretically would be okay with buying the exposure to that underlying asset, right?
Yes, you basically need to, if you're selling the put, you have the obligation to then,
Right.
Buy that.
Well, it's just kind of weird and counterintuitive to me because then you're kind of like okay with the market going down. So why is it?
Well, it's because they're hoping that they don't have to. They're just trying to collect. They're sizing up to just.
They don't want to have to buy it.
Exactly, and because they don't want to buy it, they're hoping that the market doesn't go down, so they keep collecting the premium.
Yeah. Well, in that case, that sounds bad. Yeah. It makes sense to me if you're willing to just start building a bag in something.
No, I agree. I think if you want to, I'm not going to say who, but like, that's why like the other day, I think that I was like, oh, like someone was like, oh, I don't like hype or whatever. And I was like, oh, like I'll sell you some puts. Cause there's not like an active market for like puts or calls on hype right now. I would love to sell someone some puts. Cause I just know if we like pull back 20%, I would just totally size up even more aggressively. So, all right. Here's a good one. How do you hold your conviction when the data starts to go against you and you know if it's short-term trend or if it ends up being a longer-term headwind while protecting your profits? Couple elements here. What I would say is, one, in foresight, you don't know all the time if a short-term trend is going to turn into a long-term thing. However, you should have a very clear understanding if the risk reward to the upside begins to decrease. That will take place across multiple time horizons. And then what you would want to do is shift your exposure across those. So you don't have to say like, it's all or nothing. I want to buy the low and sell the high. You can shift your exposure dynamically as the data changes as well. So that's what I would kind of say on that idea. Where do you suggest getting market data to recreate your dashboards? I will be honest with you. I don't know. Maybe massive.com. At the end of the day, you need a Bloomberg. All right. Really good. Go through all the educational primers, guys. Again, one of the things that I talked about is on the website right here. Go through all the educational primers. So they're all right here. There's an entire list of them. One of the ones that I talked about recently is the interest rates trading playbook. Trying to understand interest rates, Go through that entire trading playbook. It's free. It's right there. You guys should go through it. All right. Last couple questions. Yeah, it's a good strategy other than recession risk of selling puts. Yeah, large drawdowns. I sell calls at cost basis. Yeah, again, there's, yeah, no, not really. I don't think you understand, but that's fine. Is the plan to hold longs until SpaceX IPO? We'll see about how that works and how it functions. Right now, I am bullish, and I think that all the, especially equities and PER and ES, I think they're all going to rally a lot. Moving forward, we're already seeing gold and silver tick up. We're seeing all these moves take place. The euro kind of bid a little bit on the day. Bonds hold these levels, especially ZT holding these levels, which is all super positive. So we'll see how that kind of takes place. All right, guys. Thank you for joining the live stream today. We covered a lot. If you are here, spend time going through the recording, spend time going through the deck that I'm going to lay out and send out later today. And, you have a weekend ahead of you where you get to be intentional with your time to either reset or to be able to do more education, more reading, more thinking. So I would challenge and encourage if you go through the live stream again, spend time thinking about, how are we in the macro regime? How am I taking bets in that? How am I correctly analyzing the situation, as well as adding tools to my mental and intellectual arsenal to make really solid decisions over time? So that is what I would challenge and encourage everyone to do here. James, final thoughts for everyone on the live stream.
Nope, just keep showing up. I think this weekend, you're starting to lose sensitivity to all the kind of barking that's going on out there. You could feel it every weekend prior to this. Everybody was a little bit more intense and up in arms, and starting to feel like I'm a little bit like just so hands off on the weekends these days. But it's nice to have the option, hopefully soon, as an American, to be able to trade across the weekend like a lot of people are on Hyperliquid. So that's it. Good luck.
All right. I like it. Everyone, we'll catch you guys Monday. I'll lay out more on the Capital Flows Research website over the weekend, and we will see